Joining us now, Alec Young, Managing Director of Global Markets Research at FTSE Russell, and our guest host for the hour, Kate Moore, Head of Thematic Strategy for BlackRock's Global Allocation Investment. I guess I shouldn't even ask whether the day will ever come where the overall economy is not as dependent on every minute little action taken by the central banks around the world, because that's not where we are right now, and every little minute action is paid to with a lot of attention. So let's not even, I hope for the day that comes where it's just the underlying economy and we don't just care about free money.
There is some good news on that. The Fed fund futures have gone from a 95% chance of a quarter point today to 65 because we did have some better than expected retail sales late last week. So I think the market's feeling a little more comfortable about the consumer story and that, our economy is not on life support. So yes, I think the Fed is a backstop. They're cutting from an insurance perspective, but I don't think they're cutting because there's tremendous near-term urgency. A lot of the risks, as we all know, are global. So we do expect them to go, but it seems like people are a little bit more optimistic about the, especially the consumer part of the economy.
So we referenced last night. We had Mike Wilson on last night, Morgan Stanley. So his range is 2,700 to 3,000. We're at 3,005 again on the S&P. China's coming to talk in October. Fed's going to cut again. Should he stick with 2,700 on the low end, 3,000 on the high end, or do you raise the low end to 3,000 and put 3,200 on the high end? Which give me a forecast here.
I think we may be able to push that high end a little bit, but I kind of see Mike's overall point. Here's the challenge. I mean, there is the possibility that in early October we'll be pleasantly surprised with the trade news, but the pattern has been, they set new talks, the talks disappoint, markets sell off, they set new talks, markets recover. And I think in order to get consensus earnings growth for next year is around 9%. For that to happen, you need the current tariffs to be removed. You need a real concrete, solid, positive trade deal. Without that, we're stuck in a low to mid-single-digit earnings growth environment. And I think Mike's point, we would agree, the market's at 17, 18 times. That's fair value if earnings are growing what they are now, 5%. To get multiple expansion, to get 3,200, 3,300 on the S&P, you need at least 7, 8, 9, 10% earnings growth. Right now, the street's at minus 2 or 3% for the third quarter. We'll probably beat that. We'll come in flat. There's no room for multiple expansion with earnings not growing. The problem with the tax cut, it set a really high bar last year. So the comps are tough. There's not a lot of earnings growth around. So I think that's why the markets, frankly, I think most people are impressed the market's done as well as it's done.
Yeah.
I would argue, though, that while earnings are likely to get revised down for 2020, 100% in that camp, the multiple story, the valuation story is really contingent on the rest of the opportunity set. If you think about every asset around the rest of the world, nothing is particularly cheap. Right. And so can we stay at 17 times, perhaps get another turn on? Yeah, I think it's highly possible given what happens in the rest of the asset universe.
Here's the thing, though. If the numbers for next year, as you said, come down, we're not at 17 times.
We'll be slightly above. But again, it depends on what happens, in the yield environment.
So you think we can get to 19
product.
times on a mid-single-digit earnings growth? I
think it's possible. And look, if we get some of these ticks on the policy side, you mentioned the China trade stuff. If we get greater support from global central banks, I'm not just talking the Fed, you could get an environment where the market grinds a little bit higher. I think the pain trade is still a little bit up for equity markets. And so while I see all of the rationale for strategists on the street to keep their range between 2,900 and 3,000, it's possible the market pushes higher.
Even you're talking about grinding higher. Even a bull you're not really pounding the table.
So that's
relative to where I was 6 or 12 months ago. No, I'm not pounding the table.
That's what you want.
Yeah, so downside significant, upside grinding higher. Not a fantastic risk.
Why not? That's what you want. You don't want people to say, yeah, it's going to be easy sailing higher, then it's not going higher. You want people to hate the bull market. You want people to say
you have all the sentiment stuff going for you. That's true. The behavioral.
We've had it going for us this entire run, I would say, unloved.
Yeah.
But to play the devil's advocate, you just mentioned retail sales, and actually some of the macro data has been, pretty strong. We're quite constructive on the consumer in general, and think it'll carry the economy forward.
Tell them, Kate.
So if we don't end up having a deterioration there, are you really worried that we should be taking down earnings that aggressively that we need to take down the overall market?
I think the challenge is that if you look at the market's bifurcated, so that everyone knows consumers work. If you look at the valuations on the Home Depots, the McDonald's, I mean, these are not Starbucks. These stocks are expensive. And one of the reasons we've had a reflex move out of momentum into, I think a lot of people were like, wait a minute, these stocks are running too far. Companies like Waste Management, defensive, low vol stocks, great companies, but you've got a lot of these stocks trading at 25, 30 times earnings. The fact that the consumer's strong, that cat is out of the bag.
What's true? Don't imply that the stocks you just mentioned are 25 and 30 times earnings. Which ones?
All the ones I just mentioned.
Home Depot's at 25 to 30 times.
Yeah, I mean these are not expensive. I mean McDonald's makes $7, $8. It's over $200. So you do the math. These are expensive. These stocks are expensive. There's been a real crowding into what works.
With sustainable earnings growth, or are they expensive because they're going to be able to grow throughout all parts of the cycle? I mean, I think that's what investors are looking for right now: sustainable, consistent earning streams. And, they're willing to pay a couple turns higher than the rest of the market for it. If we have a good company with a good balance sheet, with
I'm just saying that the companies
earnings.
are going to need time to grow into those valuations because they're stretching the envelope.
If as far as multiples, maybe they don't expand, but I mean the Fed is still in cutting mode. Central bankers are still easing. I mean, there's no reason to think that that rates are going to spike, even though they've come off their lows.
Yeah,
but I mean, there's no reason to think you're going to have a multiple contraction. These are good times in terms of where interest rates are.
The drawdown, it's hard to argue for a big drawdown. Trade's the only wild card. So we really need to know. So far, you got to go on the track record you've seen. There's some big structural issues. They're not going to be resolved overnight. I think the best we can hope for is if they can get rid of the tariffs, if they can get the tariffs that are in place, if those are lifted, that's immediately accretive.
What about
to
the
earnings.
election?
I think that's what we need to see.
I mean, as people start talking about some pretty extreme views that are going to come out and kind of wondering what happens with that.
I mean, I find the market tends to look out 6 to 9 months. So the electoral question, I think, is more of a January type of conversation. Maybe November,
Not that
December.
far away.
The other thing is we don't even know who the Democratic nominee is.
No, but it looks like it's firming up a bit. And
right.
depending on who that might be, it could be something that makes
all the institutional polling I see, the street thinks Trump's going to win. So they're not, I don't think, frankly, they're taking a lot of these people very seriously. Yeah. But obviously, that could evolve. I think it's a little early. I think trade is the big macro thing. And unfortunately, the track record is just not good. The track record is investors get ahead of their skis. They get overexcited. We draw down and we rinse, repeat.
So going into year end, then, is your expectation that we'll end higher or lower than current levels?
A lot of it depends on what happens in October. We don't forecast. If we have high conviction, we'll put something out.
I think we know. Biden and Warren are beginning to separate themselves from the rest of the Democrats.
Right,
but I think it's going to be,
two different. I mean,
it's going to be Biden Warren.
Right.
But who?
I think it's going to be.
You think it's Biden between the two of them?
Biden Warren, he'll serve one term.
But do you have a lot of confidence in who wins between those two? I mean, that's how.
Oh, he's just saying a ticket between the two.
No, he thinks that's the ticket.
I think that's the ticket.
He doesn't think that. He thinks Biden wins the nomination.
I'm making that
Warren
call
on the ticket.
I'm making that call right now, but I change calls. I can change it.
Mark your.
I can change it at
6:23. September 18th.
I could change it at 7:23. But right now, that's my call.
Interesting.